Are we good? Yeah. Okay. Thank you, Naz. Good evening, everyone. Welcome to the Audit Committee meeting. Filming at meetings. So I am Councillor Daldogan. I am the chair for the Audit Committee. Please note that this meeting is recorded by the Council for the live and subsequent broadcast via the Council's internet site. Officers will introduce themselves when speaking. Apologies for absence.
Yes, Chair. Apologies have been received from independent member Rena Deba and Councillor Mary Mason.
I have also received apologies from Councillor Dana Carlin. She attends to this meeting as observer. Any urgent business?
None recorded, Chair.
Thank you, Naz. So declaration of interest. Does anybody have declaration of interest? Deputations?
None.
So minutes from the last meeting. I know there are 2 new members, but we have other old members. Did we have a chance to look at the minutes? Are we okay to agree them? Yep. Okay.
My point is about the action tracker. Okay.
So minutes agreed, right? Okay. So the next the action tracker, but I'll come to you in a minute. Yep. So as per the action tracker, I received a query from Rennie who asks, is there any further update on the status of the commercial procurement system implementation? There were questions raised from previous meetings on the cost to date, anticipated savings from the system implementation. I am not sure that we received this information to date. Grateful for any color that can be afforded. So.
Thank you, Chair. My name is Minesh Jani. I'm the Head of Audit and Risk Management, and I'll answer this question on behalf of the service. So I know the service is pulling this information together, but hasn't sent it to the committee yet. After this meeting, I will do a quick email and make sure that they provide that information.
Thank you, Minesh. So I got just a few questions in relation to the action tracker. So if we can look for page 16, under Jonathan Kirby. So, we have the status and who by. So there isn't any status on that item. So the item is about a report on the meanwhile use and the core location use would circulate to the committee when it becomes available. So there isn't any kind of status there. And also, just one more quick question. So we have a number of action has been completed. It is worthwhile to update the committee, maybe with a written response on those completed ones, such as the Pandaren, which is on page 17 at the bottom of the page. So if those actions are completed, it's good to update the committee.
Yeah. Mine is more general. The question. First of all, got a lot of issues here listed or actions from going back 3 years. If they're completed, they should really be removed from that list because they confuse the picture. And I think the best way normally is the chair outside the meeting agrees this now has been completed. We can remove it down. The second thing is there are too many who say initiated, some from 2014 and things like this, 2024 and things like this, etc. No indication why are still outstanding a year and a half later or two, etc. What the dates there might be. It's just a bit of a good housekeeping sort of thing. So I think we should really double check these things a bit more, in the preparation of what is presented here to be very readable and easy to understand and help us. Thank you.
You want to comment, Minesh? Thank you, Councillor Dagidis. So, Councillor Rossetti, do you want to cover?
I just want to point out on page 21, I think it's a duplication because the first action internal audit in the meeting prior that limited assurance of Broadway Farm, I think that's the last one because all the next ones, they seems to have already been presented on page 19 and 20. So, I mean, I've double checked, but I got this impression, so.
Yep, did you know?
Thank
So,
you.
Riaz, you had the question?
Thanks, Chair. Riaz Jacobs, independent member. Two questions, please, Chair. On page 19, the action relates to the cloud strategy. I wasn't clear what the leisure services had to do with the cloud strategy, and I think we may have just captured that incorrectly.
Which page?
Page 19, the first row.
Cloud strategy, yeah.
But in the middle of that point, we referenced the leisure services being brought in-house. And it wasn't really clear how that relates to the cloud strategy. And then
Yes.
secondly, just lastly, and it's related to Rena's point about the procurement system. Well, it's been a year and a half since we raised this issue. So I would like to see dates on the action list on when we're actually going to receive this report, because I think we've been promised this for the last 2 meetings. And a review like this, project assurance reviews, they really shouldn't take this long.
Councillor Brennan? Councillor Brennan?
I also had something on the procurement where there's a where it says ongoing, and but at the end of the sort of writing, it says the review should be completed by the end of the coming week. I mean, it's dated 18th of July, but I'm presuming it's last July because of the way the dates are following. So it's July 2024. Review should be completed by the end of the coming week, and it's still ongoing. So that's actually a year later. So I'm just wondering where that has got to, because we were going to get an update once the review had been completed.
So, Minesh, you've got a couple of questions there.
Thank you, Chair. So let me start with the easiest one. Councillor Rossetti, you're right. There are 4 actions which are duplicated on page 21, 22, which are captured previously. So apologies for that. They should be taken off for the next one. Just to get to this, Councillor Diakidis is more general comments. I agree. Look, I'll make sure that we meet with the chair, and for the completed actions, we'll take them off. And your point about some long outstanding actions from previous meetings not really being completed, I think is right. I think we need to review all of the actions on this action tracker and make sure it reflects currency. And if it's not updated, to get the updates from the appropriate people, because there are some which are outstanding for a number of times. So totally agree. Thank you.
Wasn't it just before you put it on the agenda again next time, you are on the phone to everybody and say, where's the progress? Are we got any developments, etc.? And checking whether some of the things shouldn't be there anymore. That's one.
Agreed. That again, and then just getting into the specifics, in no particular order, starting from the Jonathan Kirby on page 16. I think that can be usefully captured with the report element, and just picking up the point from our independent member, quite right. We have had assurances from the service that we would receive a report. I'll follow that up straight away tomorrow, and even if possible, we'll try to get the report circulated before the next audit committee meeting, because that meeting is a few months away still. Just scrolling down, on that cyber matter, there is on the audit plan for this year, we have a specific review of the audit needs assessment. So my apologies for any confusion, but what should happen in terms of process is that the new audit needs assessment should inform the IT plan from next year onwards, because what that should do is highlight all of the key risk areas and where audit input is most important. For the next meeting, I'll bring the audit needs assessment once completed. So you've got the sight of the overarching framework for what the auditors believe the risk areas to be, and where that particular audit then sits in amongst all the audit areas in ICT. And hopefully that should give us a bit more assurance that we're capturing all the key areas of risk. The background to that particular audit was that we'd actually cancelled that audit. It was on the plan, but we didn't go ahead with it because we did something else instead. But you're quite right to raise the question about whether that should still be on our overarching risk appraisal of audits. And I'm planning to capture that through the audit process. Sorry, I've got a few more to go through. Procurement. We had an update from Tarin at our last meeting, where she went into a lot of detail around what was happening with the procurement cycle, and in particular, the new system implementation, which hadn't gone to plan. But that reference to an activity being completed within a week actually happened. So there was an appraisal of the new procurement system as was being implemented, but other matters have now superseded that. That particular appraisal wasn't shared with the audit committee. It was more for the officers to consider what they would intend to do with the new procurement system. But if it's helpful, I can ask Tarin to again update the committee.
Tarin is on the call.
Yeah, but if it's helpful for the committee, look, we can get an update to the committee on where we are. Sure. That's fine. Have I missed anything else? I think I've got a feeling I might have.
Tarin, do you want to come in?
So sorry, Chair. Yeah, if I could just come, actually, I will pick up on a couple of those actions because the property ones fall under myself now. So I'll make sure that we go through the action track and we've got a fuller update for next time. And just in terms of procurement, I think the action that I think, and sorry, I joined a couple of minutes late, but I think it was referring to the assessment that was carried out this time last year. Actually, I can remember being here in my first audit committee that did complete, but I'm happy to commit to bringing to the committee a fuller update on procurement more generally, including the e-procurement system, a full written report for next time, Chair.
Thank you, Tarin. Yep. Okay. We're good. Right, I'll move on to the next item on the agenda, which is the external audit plan for 2024 and 2025. Can I now invite officers to introduce the report? Josh Parkinson and Tim Cutler. Or do you want to start off with first, Casey?
Yeah, thanks, Chair. I'll be introducing the report and then hand over to Tim.
And hand over to Tim. Okay, that's fair enough.
Yeah, it's just the cover report. Thank you very much. Good evening, members and colleagues. My name is Casey Kegu. I'm the Chief Accountant, and I'm here with Sir Commander.
If you can speak to the mic, Casey, so we can hear you properly.
Okay. Good evening, all. My name is Casey Kegu. I'm the Chief Accountant, and I'm here to introduce the draft audit plan report, which will be presented by KPMG, our external auditors who are here with us today. The Account and Audit Regulation requires us, as amended in 2024, requires that we complete the audit by the 27th of February 2026. We have published the draft accounts, and the draft audit plan that you'll be looking at today has been discussed with officers, and we are committed to providing all the necessary information to help KPMG complete this audit by that date, the 27th of February 2026. So this cover report is just, it's not a decision report, it's just for you to note the contents of the cover reports, the draft audit plan that will be presented in a few minutes by KPMG, and any further oral updates that we presented as part of this meeting today. Just know that we are open. It's just a draft audit plan, but we are open to any suggestions, recommendations from you in terms of how we can make this audit smooth and timely. Thank you. I'll hand over to Tim.
Good evening, everyone. For those members who haven't met me before, my name's Tim Cutler. I lead the external audit on behalf of KPMG. So tonight we have for you the second audit plan. So this is year 2 of our appointment with you, and we've brought you a draft audit plan. So I'm going to hand over to Josh to say a little bit about that shortly. But before I do that, I thought it'd be useful, firstly, to give you an update on where we are in terms of progress. There's also 2 omissions from this plan. Firstly, the VFM risk assessment, and secondly, the strategy for building back assurance. So I'll say a little bit about both those things, what we intend to do, what you can expect to see over the coming months. So firstly, in terms of progress, as Casey's just said, the authority have successfully published a set of complete financial statements by the 30th of June. So very commendable, given some of the pressure they're working under. Not everyone in the sector has achieved it. And also an advance on where we were last year. So if you remember, I don't think that was achieved last year. So obviously we're a step ahead already, which is good. We have been able to progress a lot of our financial statements audit planning, and the culmination of that is in the document we have for you today. The 2 omissions that I've talked about, firstly on value for money risk assessment. So as you know, last year, we presented a value for money commentary with a number of weaknesses within and recommendations. Management have been providing evidence to us over the last few months. We're currently scrutinising that. There's actually interviews with officers happening this week while we're down for the audit committee to progress. So the work this year forms 2 parts. Firstly, it's following up the weaknesses and recommendations that we raised last year to see whether progress has been made and whether that's sufficient. Secondly, and obviously relevant at the moment, is we're going to look at the current risks the authority is facing and make sure our risk assessment appropriately deals with those. And probably that's one of the main drivers for the reason it's not there today. Clearly, there's a lot going on at the moment. I've got conversations with the chief executive and with Taryn over the coming weeks to better understand that position, to make sure our value for money risk assessment can fully reflect that. Secondly, the work that's still yet to be done is around the building back assurance. So since we last met and since we last concluded the first year of our audit, guidance has now been issued by the National Audit Office, working in conjunction with the Financial Reporting Council, to provide a methodology to auditors to underpin their approach to restoring assurance. So again, you will recall you had 3 disclaimed periods, or 4 including the first years of ours. That obviously casts quite a high level of risk around the accuracy of the reserves position. So the work we need to do at some point is to properly assess the risk of material misstatement to those reserves and then do appropriate work to be able to restore assurance to you. Now, if we talk about prioritisation over the next few months, when we got to the end of year 1, there were still some omissions in the assurance that we were able to give you, not just reserves, but obviously there were elements of the closing balance sheet that we had yet to conclude upon. Property, plant and equipment as an example, debtors, creditors were another couple of examples. My priority and our priority for this year is to try and restore an audited closing balance sheet as much as possible, aside from reserves. If we're able to do that over the next few months, we can then move on to the process of building back assurance. But the priority has to be to get that audited closing balance sheet and in-year income and expenditure account to give you that assurance that in-year transactions are operating as they should do. So that will be the priority for the next few months. And obviously, when we come back to the November meeting and then again the February meeting, we'll give you updates as to how that strategy is progressing. Okay. I'll pass on to Josh now to just present the overview of the financial statements audit plan, and then I'll happily take questions following that.
Thank you. So to introduce myself briefly, I'm Josh Parkinson. So I'm a KPMG manager in the public sector audit team. Been at the firm for almost 7 years, worked across a number of different entities in the health, education, housing and local government sectors, including obviously last year's Haringey audit. So what you've got here is the external audit plan for 24-25 year end. So I'll take you through a few of the key slides and then happy to take any questions at the end. So I'll start with materiality, which is on page 4 of our pack. So materiality is essentially the threshold that we consider significant enough to impact the decisions of the users of the financial statements. So for 24-25, we've set that at just under 2% of expenditure, which you'll see on that slide there is 26.4 million. We've then got our performance materiality, which is a number slightly lower than this that we've set at 65% of materiality. And this threshold is meant to prevent and protect against aggregation risk, such that all of our misstatements we identify in total will be below that materiality figure. So we use that number when we design our audit procedures and perform our work. And we've set that at 17.1 million. We've then got our audit misstatement posting threshold, which is the level at which we will report any errors to those charged with governance, so to this committee. And we've set that at 1.32 million, which is 5% of materiality. So the next key slide then is our significant risks, which starts on page 6 of our pack, runs through till page 10. I'll just give you a bit of a high level overview of all of them. And then, as Tim said as well, happy to take any questions. So the first one we've got is the valuation of land and buildings. This risk mainly driven by the size of the balance. So it's around £3 billion for 24-25. And it's driven by the estimation uncertainty in those underlying assumptions that underpin the valuation, such that any small change in those assumptions could potentially cause a material error in the balance. We also use our in-house valuation team to do part of the work on this, just due to the complex nature of the balance and some of those assets. The next significant risk on there is the management override of controls. This is a mandatory risk on every audit and essentially covers our work to address the risk that management may look to manipulate the financial statements through things like journal postings or overriding controls that may be in place. I would say we haven't identified anything specific to Haringey in this that we've put in our plan. This is just a mandatory risk that we include on every audit. The third one then is the valuation of the defined benefit obligations. So this is similar to the valuation of the land and buildings risk in that it's driven by the size of the balance. So this is the obligations in relation to the local government pension scheme, which are around £2 billion at the 24-25 year end. And again, any small change in the underlying assumptions that are used, such as mortality rate or inflation, could cause a material change in this balance. And then the final one is expenditure recognition, and specifically the completeness of manual accruals. So the risk here is about accruals being omitted from the accounts. So essentially, we've said that driven by the financial pressures that management and the council are under, there may be added incentive to manipulate the accounts and to push back 24-25 expenditure into 25-26 by omitting items. And we focus that risk on manual accruals, the expenditure that's not as regular because it's easier to manipulate and it's non-routine. Page 11 of our pack then, we also give our rationale as to why we don't identify a significant risk around revenue, which is primarily driven by the fact that a lot of the revenue streams are known at the start of the year, they're known balances. And you've also got quite a few of the revenue streams are very high volume, low value. So you've got a lot less opportunity to be able to manipulate that to a material level. So I think that pretty much covers everything I wanted to go through. I mean, happy for either of us to take any questions if anybody's got anything or anything I covered or Tim went through.
Thank you, Josh. Any questions? So I got Councillor Diagidis, I got Councillor Rossiti, and I got Councillor Walsall. And now Councillor Diagidis.
Thank you. First of all, can I start by saying, looks like we might be starting to see the light at the end of the tunnel after all this things that are happening until now. And I really welcome the earlier timetable now and setting it up. There is something about, first of all, before going further, about the past ones, outstanding audits that have been completed or they are qualified one way or the other. Are we still working to clear them? Are we going to have some timetable of it, or are we continue in perpetuity now that every next year's audited accounts, they are qualified always because we don't know what the outcome, we haven't, confirmed the outcome of the previous one. So that's the first question. Is there something around that I should know? I got a question about the materiality, which may be more for my own understanding, but I do see that you've raised here the amounts and the percentages from previous years. So for the financial statements as a whole is going up to 26.4 million as the thing, and so on. One thing that perplexes me is, first of all, why did we have to raise it? And what is the implication of raising it from the previous levels? And within that, maybe it's an easy explanation. It's got to be probably bigger accounts or whatever. But if I look at the percentage terms, seems to be about 8 to 9% increase from year to year. But if I look at the actual figures, it's 25% on each of the three categories. What is the explanation for that one? And I've got some questions about the risk. Can I just give them as a second batch? Yeah, thank you. Yeah.
Let Josh walk you through the materiality principles first, and then I'll come back and answer the first one.
Yeah, so effectively, if you look back at our plan this time last year, we used a similar percentage. So when we did our plan last year at a slightly earlier stage, we used a forecast expenditure at that point. So we have essentially, we used 2% last year. And then when the actual expenditure came in at year end was slightly higher than planned, we didn't revise our materiality. So we kept it at what it was initially, which then meant that the percentage came down. So in actual fact, we have still designed our percentages the same. The other reason for the increase is it's linked to expenditure, which is obviously increased year on year, which is partly driving that change.
Did I misunderstand the purpose of the materiality? Materiality gives us a line. If you go over it, then it has implications that treat it differently. Therefore, how can it change during the year? Either, the line is the line. There's no, you don't negotiate it, that kind of thing.
Yeah, I suppose it's the principle of it is it's a percentage of the overall expenditure in the account, so that we would change it year on year, pegging to that percentage. As I say, it does look slightly unusual there, I appreciate, but it was based on forecast expenditure at that point, which is why it is a slightly different percentage of prior year final expenditure. But the principle of how we've designed our materiality is the same, and that we've aimed for that 2% of actual expenditure.
Any message in it to say we're doing something bad, something good, and had to raise it, or had to put it down, or whatever. There isn't anything to read into that.
You want to come in, or Tim? Or
sorry, I just struggled to hear that last point. Sorry.
So your repeated question, just a question, Councillor Daigides. The question, you okay? You all right?
No.
You're right with it? Okay.
I thought I did. Yeah.
Tim, do you want to just come in?
Yeah, just to add to that point. So, and I will come back and answer the first part, but on materiality, we tend to take a very generic approach to the sector on the percentage of gross expenditure. And the reason is materiality is meant to look at the profile of the financial statements and the importance placed on the financial statements by external stakeholders. Now, pretty consistently across the sector, we view the financial statements to have lower priority to the budgetary reporting of an authority. And generally, unless you've got listed debt or are very highly leveraged with loan covenants, for example, you don't have that much scrutiny on your financial statements. That's not to say you don't want them to be wrong, but auditing standards leave us to a range between 0.5% and 3%. So at 2%, we're recognising that there is some risk in the sector, but 0.5 to 1% is where you'd expect FTSE 100 companies to be where shareholders rely on the accuracy of those financial statements to a very precise degree. So direct answer to your question, there's nothing to be read into it other than the fact your expenditure is growing. So just going back to the first part of the question then, what we will need to do to set a detailed plan to rebuild assurance is do this risk assessment that I referred to when we were talking. Just to make sure there's no confusion, it is not our intention to go back and audit the 3 disclaimed periods from FY21 through to FY23, simply because I don't think the time, the resource, the capacity of any finance teams would mean that's a sensible thing to do. What we've agreed with the NAO and the FRC is a methodology to attempt to restore that assurance based on a series of more efficient procedures, largely risk assessment, and then design specific procedures on the back of that. So what we will be doing, and we need to have further conversations with Taryn and Casey and the teams on this, is ask for relevant information from those disclaimed periods to allow us to form an assessment of the risk and material misstatement from them. Now, when we get that back and we can look, and obviously because we're talking about years 3, 4 periods ago, there might be a question around document retention, corporate knowledge, all of those things. But until we've got down to that level of inquiry, I can't sit here confidently and say to you, we will rebuild assurance, because we need to go through that proper risk assessment to then bring a plan back to you at a later meeting. And that's what we will do. So when we come back in either November or February, and bearing in mind, and I think I said this last year, this is meant to be done over a series of years. It is not expected, particularly a large complex authority with 3 years disclaimed like yourselves will be able to do this quickly. And I don't think you'd want us to do that quickly.
Thank you. So Councillor Worrell, you had a question?
Yeah, thank you. I had 2 questions. The first is probably more for our officers. So in this report, it lists a couple of challenges that there were in conducting the plan last year in terms of the quality and availability of transaction listings being one, and incomplete information around the valuation report and things like that. So I just wondered how much has changed so that all of those things can kind of be provided in full for this year. And then my other question was just on the risk approach and where you've outlined the rebuttals of risk. I was just interested about this one because obviously, even though these are predictable income streams to a degree, we do often end up kind of not collecting what we intended in terms of fees and council tax, and there's often non-payment and sometimes there are written off debts. So is that just, you find that to be sort of relatively negligible in the grand scheme of things? Thanks.
Thanks, Councillor. As you all know, we, not just Haringey, a lot of local authorities haven't had audits for minimum of 3 years, some longer than that. So, and then there's this change in the auditors to KPMG. Naturally, that last year was the first year of KPMG coming back to local authority audits and coming back to Haringey. So it's a case of, meeting their expectations and a different expectation compared to BDO, where we've worked with them over the years. We understand how they want their work papers prepared and things like that. So as a result, at the end of last year's audit, we had a lessons learned session with KPMG where they itemized these things. And what we've done since then is try to make sure that our working papers align to what they really want to see, the expectations. So I wouldn't stay here and tell you, yes, we have fully met the expectations. The audit is ongoing now, so we'll just wait to see what the audit reports comes with. But we have actually made notes of some of these recommendations, and we've improved on the quality of working papers we're presenting to them. Thank you.
And then in terms of the rebuttals of the revenue risk, what we're saying there is not that we won't do any work on them. We're just saying they're not significant risks which are likely to contain material misstatement. So our duty as your external auditors is to make sure the financial statements are free of material misstatement. We do, however, do differing levels of work on every single number in that financial statements. So what we do within the plan, rather than bring you a completely detailed sort of analysis of what we do on every balance, is just bring to you what is a significant risk. So just to give you some assurance of the 4 different revenue streams that we've highlighted there, we will still do a lot of sample testing on fees and charges, grant income, certainly enough to give you confidence there's not a material misstatement there, and it's likely to show problems in process and control if there are any of those. With council tax and business rates, what we tend to do is something more akin to a analytical procedure. So what we do is we interrogate your systems to look at, well, what are the numbers of people paying that? What's the average rate? You know, multiply it by the number of properties in different bands to come up with a prediction for that revenue. We then compare the prediction to the amount the authorities disclose and then follow up any differences. So in my view, it's a reasonable level of precision that you would want us to do in the context of your financial statements.
Okay. Councillor Rossetti.
Thank you, Chair. I want to come back to what she just said, Councillor Warren, because one of the questions I had on the statement of the account, and it's something I see every year, is that the amount of money in terms of debt from overpayments in benefit overpayments and parking penalties not being collected is substantial. So there might be a point that effectively here it says that the income represent high volume, etc., but effectively there is a lot that is not collected or overpaid. So, yeah, I think that she had a point, and I want to highlight it. My question was about the money for value state assessment, because I've seen that in the report it's mentioned that it will come to the committee at a later date. So I was wondering if you think it's going to be the November or December committee, or perhaps into the next year. Thanks.
So we certainly aim to have it for the November meeting, and perhaps earlier. And indeed, I was just suggesting to the chair before the meeting that in keeping with our approach last year, we may want to socialise something to you as members to discuss and be able to ask questions before the next meeting.
Thank you. Reyes, you're next.
Thanks, Chair. I think one of my questions around the challenges from the prior have been answered. The other question I had was the weakness in the control around approval of journals. I think it's again for the finance officers. Are we happy that that control has been addressed? It's kind of a key control. I'll bring up it's under the significant risk and management override. Page 8 of the, or 34 of the pack, the last bullet. The auditors note we are aware of the journal approval control does not meet the auditing standard threshold. Are we happy from a finance officer perspective that that has been addressed this year?
Page 8. So page 34 on the pack and page 8 on the plan.
Yeah, thank you for pointing me to the right place. I think this has to do with approval of journals, and if I recall correctly, the issue here is around who approves journals are making note that, I think what we do currently is if someone else raises a journal, someone else reviews it and then signs off that they review it. I think part of it is the journals are being reviewed, but on a few of them, it wasn't clear actually who reviewed the journal. If I recall correctly, that might be the issue. Yeah.
This is a journal deficiency that we raise on pretty much every local authority and plenty of others in the public sector as well. It largely relates to the quality of your financial reporting system that will underpin journals. In order to have a control that we can rely on, it generally has to be a system-enabled segregation of duties control. In order to rely on that, we need to have things like general IT control assurance, which we would have to test things like access controls, etc., etc. So what we have to do under management override, because it's a significant risk, we don't intend to raise this as a recommendation now every year, but we have to let you acknowledge that that control deficiency is there. Now, I know plans for the future may include the replacement of a new general ledger system, in which case you may wish to invest in a specification that supports that control, but it is a cost benefit. For us as auditors, if that control is in place and we can see it operating effectively, in theory, we'd only have to test one journal because we can rely on the automated controls in place over your system and the substantive work would be a lot less. What we effectively have to do in this situation is, because we can't rely on those controls, we have to test the entire journal's population. Yeah, so it isn't uncommon, but I suggest it's not going to be something that's rectified until the new system's brought into place.
Just follow up quickly. So Tim, I guess what you're saying that the alternative procedure that you do would mitigate the audit risk that we would typically be worried about.
Yeah, and I think that was one of the areas that we, between ourselves and the finance team, we needed to get the data in a certain format to allow us to do that. And I think that's one of the things following the debrief we're working on in readiness for this year.
Sorry.
Brennan.
Yeah, if I may add, in terms of alternative procedure, what we do currently, Tim is quite right. This might be one of the issues we address with a new system that will be coming in. But what we do currently to ensure that journals are properly reviewed is that whoever raises a journal doesn't post it. Someone else raises it, you pack it for another person to review, and then another person posts it. So there are like 3 layers really actually of review for every journal that is raised, albeit not having them that automatic control in the system.
Thank you, Casey. So I got Councillor Brennan next.
I'm going right back to the impact of backstop on our audit. I'm just interested in this thing where it's mentioned that you had difficulty obtaining or issues obtaining detailed transactional breakdowns of debtors and creditors and such like. There seem to be suggestions that there were delays in getting it to you in a certain timetable. Am I right in thinking that you didn't get the information on time, or am I misread this? In which case I was wondering what sort of delays are we talking about? Had you asked for it within 2 weeks and you didn't get it? Or had you asked for it within 6 months and hadn't got it? Thanks.
So just to be clear, these comments, whilst they are put in the context of the backlog, they are really in relation to last year's audit. And as Casey's just said, these are very much a getting to know you first year audit. What do we need in what format? And therefore the lead time in turning these things around was longer than it probably will be, hopefully this year. That is slightly separate to the work we'll need to do on the prior year disclaimed periods and obtaining information that we'll need in relation to that. So there's not a direct, it could be seen as an indication that there will be difficulties there, but that shouldn't be directly linked at the moment. It's really about a learning curve to get the testing done that we need for the closing balance sheet at this point.
Councillor Diaguides. So
Yeah, thank you. I'm just looking as a councillor the things that I'll be interested to deal with. Now look at your table on page 6 of your document, with the higher assessed risks. and there are 4 that you listed there. So the first one, the valuation of London buildings have been very high risk, comparatively, and also high implications if it happens, like likelihood. And I was just wondering whether that has got any direct impact at this moment in time beyond being an accounting issue on checking whether we are a going concern or something like this, a risk of bankruptcy, rather than anything immediate, the first one thing. And then the one that I am particularly concerned is the 2, the second one, which you put as quite a high implication possibly. Now, how you say that management has power to probably override controls of one kind or the other, etc., and put us in trouble. And you have assessed that that is a high risk in our case. Yeah. Therefore, that is quite an important issue. And we are all have been worried here for a long time, again and again. But I suspect every other authority probably are worried in this thing. But is that linked to a certain extent to for example, the level of scrutiny we put outside just simply checking whether the controls that are referred to, for example, we are keep on raising the delegation levels for decisions either for transactions or for contracts, etc., to millions of pounds now. And increasingly got even that extremely few now have to go even to the cabinet, where there's some discussion about it. Could that have an implication on it? Could some other things like the robustness of our sort of like whistleblowing arrangements or the excessive use probably of confidentiality, supposedly the access, in other words, to clear, readable information, which properties are we are intending to get rid of, for example, to sell. Why is it confidential and things like that. So some advice on that would be very, very useful, and how far your audit could go onto that thing.
So the first point, which is really, really important, is management override of controls is a significant risk on every single audit. It is a default. It is not a sign that we as auditors suspect management of wrongdoing. It is a sign that we as auditors should at all times maintain professional skepticism. And in any audit that we carry out, we have to remain alert to the possibility that management can adjust the financial statements. That's just a reality. But I think, as Josh said in the presentation, we have found no indication that they wish to do so. But if we did, we would alert you to that. I think what's important to note, and this comes down to my comment on materiality, where we look at, well, what's the level of scrutiny? What's the level of import placed on the financial statements? These significant risks are purely there to look at the risk of material misstatement in the financial statements. They're not a commentary on wider governance and operational issues at the local authority. That comes through our value for money commentary, which we'll deliver later in the year. And in that, we can comment on what we believe are management's arrangements for running the authority appropriately, effectively, looking after taxpayers' money, etc. So the reason valuation of land and buildings is at the top of that table is just purely and simply, it is the biggest number in your account by some distance, and it is a judgment. That's the only reason it's there as the biggest significant risk. Management override is there because, again, it is by default something we have to keep a close eye on. But there's nothing else to read into that other than the size and the complexity of the balances in the accounts.
Just to clarify, the management overrides, your report will advise on whether some weaknesses exist, but you're not going pinpoint where what the underlying causes might be, like the ones I mentioned. That, for example, now there's hardly any scrutiny by anybody else outside a very small number for even the largest transactions and the contracts and things like this, etc.
So coming back to the conversation we just had about the journal controls, the way we discharge our work on management override is firstly to have a general awareness. We speak to officers, we review minutes, we look for any instances of bias. The main form of looking at it is, how do you adjust your accounts? You post journals. And that's why the journals control is so important in the context of management override. So what we will do in the absence of that effective journals control is test the entire journals population. We do that by applying high risk criteria. So we get all of your journals transaction data into one massive download, which is hundreds of thousands of transactions. We screen them. We've got quite sophisticated analytical tools that screen them, and then we apply high risk criteria. So we look for who posted that journal. Is there anybody posting a journal that we wouldn't expect to post a journal? Because 9 times out of 10, if somebody's going to post a journal that they shouldn't, you know, it'll be like outside of working hours, or somebody that you wouldn't expect to be involved in the financial reporting process. And that, by that way, we assess the risk in that journal's population. So that's what we will be concluding on later in the year.
Okay, thank you, Tim. Okay, for the recommendation for this item, for the committee to note the content of the report, the draft audit plan, and any further oral updates given at the meeting by the external auditors, KPMG. Could we just note the recommendation and move on? Thank you. So the next item on the agenda is the draft statement of accounts. Can I now invite officers to introduce the report? Casey and Sa.
Thank you, Chair. Please permit me to reintroduce myself again. My name is Casey Kegu. I'm the Chief Accountant, and I'm here with Sir Commander, the Deputy, to present the draft statement of accounts. The statement of accounts by its nature is prescriptive. It is governed by the codes of practice on local authority accounting and international financial reporting standards. When we had training some few weeks ago, it was talked about how the statement is prepared in accordance with IFRS, but then there is need for adjustments to account for the nature of local authority funding and taxpayers. So this is what we do with the draft statement of accounts. And the draft statement of accounts contains the core statements, which is the comprehensive income and expenditure statements, the movement in reserve statements, the balance sheets, and the cash flow statements. And in our case, we also have supplementary statements like the housing revenue accounts, the pension funds accounts, and the collection fund accounts, and also the annual governance statements as part of the entire statement of accounts that is before you today. By the Accounts and Audit Regulation amended in 2024, the 2024-25 draft statement of accounts is required to be published by the 30th of June. And today I can confidently say that we met that deadline. We published the accounts on the 30th of June. So in looking at the draft statement of accounts before you, what we've done is we've used this cover report to highlight some key information in the draft statement of accounts around the general fund balances. So we are reporting in section 6.11 that the general fund balances, including school balances, reported for 2024-25 recorded a drop from 67.4 million at the end of March 2024 to 52.2 million at the end of March 2025. The housing revenue account maintains almost the same balance of 20 million or 20.2 million at the end of March 2025. However, we have also, as part of the draft statement of accounts, there is a section called the narrative to the accounts. So the general performance, financial performance of the borough in 2024 can be seen in that section. We've summarized the whole performance of the council in 2024 in that section, the narrative to the statement of accounts. There's something new in 2024-25 in our draft statement of accounts, and that is the adoption of FRS 16 in 2024, the first time we've implemented FRS 16 in the accounts. And what that meant, or the effect that had, which you will see in our balance sheet, is that the values we have in our balance sheet went up significantly as a result of this, because what effect this had was some of the leases that we have that we term as operational lease are now being reported as finance lease, leading to increase in the value, because what happens at the end of it is that you record them as assets and then equivalent liabilities. At the end of publishing every draft account, there's a period of public inspection which starts immediately after your account is published. So our period of inspection commenced on Tuesday, the 1st of July, and will be ending on Friday, the 11th of August. And in that period, it's expected that residents, anyone, can actually raise objections to the accounts, ask to inspect any aspect of the accounts by writing to us. And if they want to come to the premises to carry out such inspection, they're allowed to do that. So at the end of 4 p.m. on Friday, the 11th, that public inspection period closes. So what's next? What next is what we've just heard now. After that, which has already commenced really, is the audit of these accounts, which KPMG has commenced. So this report before you is just for you to note the content of the cover report, and also the content of the draft statement of accounts before you, and also for you to make your observations and recommendations to help us improve on the preparation of our statement of accounts in the future. Thank you.
Thank you, Casey. Is there any questions? Okay. Councillor Diaguidis, you want to come in?
Yeah, thanks. I'll pick up a couple of things. On page 61 or page 5 of your report, of the draft report, yeah, there is the reference to the exceptional financial support. I probably stupidly didn't understand in the past. Already, we have dealt with 10 million for the past year. And that the 37 doesn't include the 10 million. It's an additional 37 million for the next year. That's the first. We had to.
For 2024-25, what we use is 10 million. The 37 relates to current year 25-26. But just like 2024-25, if you recall, what we applied for or what we approached government for was about 28, but we ended up needing only 10 million. So by the end of 2025-26, we will find out exactly how much of the 37 million that will require, or maybe none at all.
I am particularly concerned about a couple of things here. The housing benefit overspend that you got there, which, I mean, if you could explain it, it is something like £3 or £4 million or something. I can't remember the precise figures. That is the first thing I wanted to ask. I mean, why are we in such a state with a housing benefit? That should be more or less self-financing.
Tyrone is also on the call if you want Tyrone to come to the
Okay,
team.
all right. Let me leave Tyrone to answer that.
Okay, thanks. Tyrone, do you want to come in? Thank you.
Yeah, thank you, Chair. If I just come back briefly on the first question, Councillor. So the 10 million, as Casey's highlighted, was what we needed to utilise of the 28 million that we had agreed in principle from government for 24-25. The 37 million is relating to 25-26, and that's what we estimated will be our pressures. So when we came up with the 37 million that we think we need to use to balance the budget for 25-26, we would have been looking at the pressures that are coming through for 24-25. So it isn't necessarily 10 million plus 37 million, because when we set the balanced budget in March, we'd anticipated some of the pressures that were coming through from 24-25. But we're keeping a really close eye on it, monthly monitoring, and the first quarter report will be presented to Cabinet and then to Overview and Scrutiny Committee in September. So that's when we'll be able to give a better indication. So it's not necessarily the 10 plus the 37, but we'll need to see what those pressures are. In terms of the housing benefit position, you're right, it is quite unusual. It tends to be money that we receive in grant that then obviously gets redistributed as part of housing benefit. We have got a few challenges here in Haringey, and I think they've been evident for a couple of years now. It was reported back in 23-24 as well, the outturn. So we have got some historic overpayments that we are trying to recover. So this is where we've overpaid benefit claimants, and that remains outstanding. And what we did do this year was we looked at taking a more realistic and prudent assumption about how much of that is achievable. So some of that is driven by bad debts provision on the overpayment. And the second, I suppose, issue is around supported exempt accommodation. So the amount of housing benefit that people are entitled to if they're in supported accommodation is different if they're in to what they are when they're saying normal private rented accommodation. So there has been some errors in that calculation as well. So that overspend is largely driven by an increase in bad debts provision relating to housing benefit. The only thing I would say, and I know that Overview and Scrutiny Committee is actually happening at the same time, the full outturn report, and so that like the management reporting on the outturn position is set out in that report and is taken in full to Overview and Scrutiny Committee tonight. It went to Cabinet. What the narrative report tried to do is to provide an overall summary rather than the specific details which are talked about at Overview and Scrutiny Committee. Thank you, Chair.
Thank you, Tyrone. Thank you so much. You got a subsequent question? A quick one, yeah? Thank you.
Yeah, the questions. Now, there is a reference here about we have to increase a lot our pension fund contribution, basically, the side of it, something like £300 million, etc., after the latest revaluation. I'm a bit perplexed about that because at the draft plan, the audit plan that we got from the external auditor, there is a reference there that local authorities are increasingly finding themselves in surplus in their local superannuation funds. But according to the figures that you referred to here, we are actually making a huge loss. And I know that they're not comparing like with like, but I just would like to understand how come, or are we one of the authorities that don't make a surplus out of it due to the current financial, state of the market? I think financial markets is the term we use, that kind of thing. Or is it something else? Why do we have to put a lot more money into our pension fund from now on? In the light of what seems to be nationally a better picture for pension funds.
Thanks, Councillor Diakidis. Let me, I'm happy the auditors are here. Let me start from the comments in the audit plan. I think, team, if I, I think what the audit report is talking about is based on what they have observed. Obviously, it's talking about 2022 or 2023 position, because that report would have been written earliest at the time we are completing the 2024-25 accounts. And that's quite right, because even if you look at the 2023 position, you had a net asset position. It was net assets of, I think it's 87 million. So am I correct? 87 million. So these things are done every year, annually assessed by actuaries. And they have the assumptions they use to do these things. It's quite complex. I can't stay here and start to tell you that I understand it or I can explain how they do it. But definitely moves. It moves from year to year, and they've done that assessment, and and it was assessed that, look, it's a liability of 300. And if you go back in our accounts for prior years, you will see movements of about 100 million, even though, yes, 300 seems large. But you look at it realistically, they are talking about future liabilities. It's not as if this is the actual payment or spend in a year. It's talking about future liabilities. There are a lot of factors involved in this valuation. So if you want us to speak to the Haymans and get a layman's explanation of what really happened and why, we can do that for you.
Tim,
And so we
wants
need
to
a
come in,
clarification on this issue.
as Tim wants to come in to clarify the point. I think.
Yeah, so it's worth putting the context that we make, the comments we make about surplus in the context of what you're seeing in the accounts. So in actual fact, assets do outweigh liabilities, but under accounting rules, you can't benefit from that in your accounts. There is something which takes effect called the asset ceiling. The way local government pension schemes work is you can only recognise a surplus if you are able to extract that in the form of a refund at any point in time. And local government pension scheme funds prevent you from doing that. So effectively, you're not allowed to recognise the surplus you've got over the assets. Therefore, all you're left with is a series of liabilities associated with things like unfunded liabilities. So, for example, where the authority over the years might have paid pension strain into the pension fund, that will sit as an unfunded liability, i.e. you're not allowed to offset the assets against it. So in order to look at the more general health of the pension fund, you're probably better looking at the just reported position of the fund at any point in time and not purely what you're seeing in the accounts.
Tyrone, do you want to come in on this point? Thank you.
If I could, Chair, and I think there's two different issues I think that are being talked about here. One, as Tim's just explained, is the in-year accounting position. I think, Councillor, what you're being referred to, you're referring to the triannual evaluation of the pension fund, which takes place every 3 years. So we're currently going through that process at the moment for the valuation as at March 2026. So that will get reported in next year's. So 3 years ago or 2.5 years ago, the pension fund was valued at, I think, 124%, if I recall off the top of my head. We're currently working with the actuary Hymans at the moment to look at the current triannual evaluation. And I think, as you pointed out, you know, it's been trailed quite publicly that largely pension funds, the surpluses may have increased, but we're currently going through that process at the moment. That will complete towards the end of the year. And our actuary is actually presenting an update in terms of the work that they've done to take to Pensions Committee and Board on Thursday. But they're two slightly different issues. I think, Councillor, you're referring to the triannual valuation. So what I can give some assurance is that our pension fund, I mean, it gets reported to every Pensions Committee and Board. It hasn't gone into deficit. It's still in surplus. We're just looking at how that surplus compares to what was reported back in 22-23 when the last valuation was. But if I can give you that assurance, our pension fund it's not going into deficit.
Thank you, Tyrone. You okay? Okay, thank you, Tyrone. Reyes, you have a question.
Yeah, just a quick one. I think the financials make quite a lot of reference to the overspend, and then also our saving initiatives. And I guess my question is around how rigorous is the scrutiny around whether we're achieving those savings or not? And I guess with the chair's permission, will it be worthwhile for us as a committee to have sight on the progress of the achievement of those savings, even if it's not at every meeting, but maybe every second meeting? Because I must admit, I was a little bit surprised at the last meeting when we said, oh, we didn't achieve X amount of our targeted savings. So I'd rather not have set surprises if this is quite a key initiative that the council is looking at.
Yeah.
Yeah, let me.
Stacey.
Yeah. In terms of our savings, I think what we have gotten better at now is monitoring the savings. So as part of our monthly budget monitoring, we report on the progress of our savings now, and and also this savings, progress of our savings will be reported to Cabinet quarterly. So you will see